Welcome to The Deep Dive, the show where we give you the shortcut to expertise. Today, we're plunging into the high-stakes world where AI meets Wall Street. We're talking about reinforcement learning and how machines are now learning to, well, actively trade, manage giant portfolios, and make markets.
And this isn't just theory anymore. To really get a handle on this, we're looking at a huge piece of research. It's a systematic review that synthesizes, I think it was 167 articles published all the way from 2017 to 2025.
Wow, so we have a really clear evidence-based picture.
Exactly. We can see what works, where it works, and, maybe more importantly, why it works.
Okay, so our mission for you today is to get you up to speed fast. We want you to walk away understanding exactly where reinforcement learning, or RL, is actually delivering an edge. And critically, what factors are driving that success. Because, and this is a bit of a spoiler, the data suggests it's not always the most complicated algorithm that wins.
Right. And to really appreciate why this is so hard, you have to get the context. Finance is maybe the toughest domain for any algorithm. You've got high dimensionality, so thousands of inputs. You have these complex shifting dependencies. And the big one, non-stationarity. The market doesn't just fluctuate. Its underlying rules actually change.
So the goalposts are always moving.
Constantly. And that's why traditional models, econometric models, they really struggle. They just assume too much stability.
Okay, so if the environment is always changing, how does RL even start to learn the rules of the game? Can you frame that for us?
Sure. So RL is fundamentally adaptive. The core idea is that an agent or algorithm learns by doing. It interacts with the market, the environment over and over again to try and maximize a cumulative reward over time. And this whole framework is called a Financial Markov Decision Process, or MDP.
An MDP, okay, let's break that down. What are the key pieces the algorithm is juggling in this financial ecosystem?
You can think of it as three main pillars. First is the state space.
The state space.
Yeah, that's all the information the agent gets to see. It can be super diverse prices, technical indicators, news sentiment, you name it.
Okay, so that's its view of the world. What's pillar two?
That's the action space. This is what the agent can actually do. And this really varies. It could be continuous, like allocating, say, 4.7% of your portfolio to Apple, or it could be discrete, just a simple buy, sell, or hold.
And I'm guessing the third one, the reward function, this is the make or break part, right? This is where you have to build in all the real world rules.
This is where the engineering gets really complicated. And it's why you need that deep domain expertise. The agent is, well, it's a bit like a utility maximizing psychopath. It will do whatever it takes to maximize its reward, even if it's destructive.
So if you only tell it to chase returns, it's going to ignore all the friction.
Precisely. You tell it to just maximize profit, and it'll happily make 1 million tiny trades and blow up your transaction costs. Or it might take on some insane amount of leverage to goose that short-term reward. So the reward function has to be engineered to balance return maximization with risk control, transaction costs, and even regulatory compliance.
Getting that balance right is the difference between a successful algorithm and one that, causes a flash crash.
It's the whole game.
Huge. Okay, with that framework in mind, let's get to the results. Where is this technology actually making money? Where does RL excel?
So the review broke the applications down into three main buckets. You have portfolio management, algorithmic trading, which was the biggest group with 62 papers, and then market making.
And how did they stack up against the traditional strategies?
Generally, RL shows a pretty clear advantage. The review calls this the RL premium, the extra performance you get over a standard benchmark. But the gains are very concentrated in specific areas.
Where's the biggest concentration?
The clear winner, by a long shot, is market making. The applications there showed a really impressive RL premium of 0.488.
Wow. So that's almost a 50% uplift in performance compared to the old methods.
Exactly. It's a huge gain.
So why market making? What makes it such a perfect fit for this kind of tech?
It's because market making is, at its core, a continuous control problem. You're constantly tweaking things, your bid-ask spreads, your inventory risk. It requires these instantaneous adaptive decisions, which is perfect for certain RL methods, specifically actor-critic methods like DDPG. They really dominate this space because they're built for those continuous action spaces. They can adjust those spreads with incredible nuance.
That's fascinating. It's not just a prediction problem, it's a real-time optimization problem. What was the next best area?
The second highest premium was found in cryptocurrency trading. It was 0.375.
And that kind of makes sense, right?
Yeah, it's not a huge surprise.
Yeah.
Crypto markets are famously volatile, and they still have a lot of inefficiencies that a fast-acting RL agent can, spot and exploit.
And what about that biggest category, algorithmic trading? What was the story there?
It's a bit more of a mixed bag. Overall, it shows substantial outperformance. For high-frequency trading, for instance, you see algorithms like Rainbow DQN doing really well with discrete actions, like placing a specific limit order. But in classic portfolio optimization, allocating across stocks and bonds, the gains were more modest, almost plateauing.
So that area is more mature? Maybe the low-hanging fruit has been picked?
That's what it suggests, yeah. It seems pure RL has a harder time extracting an edge there without being combined with other things.
Okay, so we've mapped out the high-performance zones. But this brings us to the real core of the review, the part that challenges what everyone thinks they know. We're going to look at what really drives this performance, because the idea that more complexity is always better. Well, your sources say that's a myth.
It absolutely is. And this is the part where, practitioners really need to listen up. The data is pretty clear that the race to just implement the newest, fanciest neural network is often a waste of time. The true predictors of success are things like implementation quality, domain expertise, and just really rigorous data preprocessing.
That's so counterintuitive.
Yeah.
In a world obsessed with big data, you'd think feeding a model more information would just naturally make it better. Let's see the stats that back this up.
Okay, let's start with the data. The analysis across all 167 studies found no statistically significant link between the number of features you use and how much better the RL agent performs. The slope was really weak, 0.171, and the p-value was super high, 0.499.
Hold on. So throwing 1,000 technical indicators at the problem instead of just, say, 5 doesn't reliably improve the result.
Correct. The data suggests that once you have the critical features, adding more just adds more noise, not more signal. And it's the same story with portfolio complexity. The benefit of RL doesn't really scale with the number of assets you're managing. The p-value there was 0.362. RL's main advantage is its adaptability, not just its ability to crunch big numbers.
So what about the algorithms themselves? Should I be panicked trying to switch from a policy gradient method to the latest DQN?
Nope. The analysis actually showed that the performance difference between the big algorithm families, policy gradient, and DQN was non-significant. The p-value was 0.640.
That's a huge deal.
It is. It really confirms that which family you pick is way less important than how well you implement it, how you tune it, and how you frame the actual financial problem.
So if the amount of data, the number of assets, and even the type of algorithm are all secondary, what are the primary drivers of success?
Right, so they confirm this using a feature importance analysis, and the top predictors, by a huge margin, are the complexity score, which is really a proxy for implementation quality and engineering rigor, and the application domain itself, with market making being the most important, the algorithm family. Dead last. It was the least important factor.
So the takeaway for anyone building one of these systems is spend your money on top-tier data engineers and domain experts. Not just the PhD who has the most exotic new algorithm. It shifts the focus from pure theory to, well, operational excellence.
That's exactly right. The model has to be built in a way that truly understands and respects the market's plumbing, the microstructure, the costs, the risks.
Okay, so given that complexity for its own sake is not the answer, what are the leading research groups actually doing to get that performance edge? Let's talk about hybrid approaches.
This is where things get really interesting. There's a big trend towards systems that combine the best of both worlds. Hybrid models intelligently pair RL with more traditional quant methods. So, for example, you might use a powerful deep learning model, like an LSTM network, to do some really sophisticated forecasting. And then you feed that cleaner, smarter data into a DDPG agent that's just brilliant at the continuous control part, making the final decision.
That makes so much sense. You're using the right tool for each part of the job. Are these hybrid systems actually performing better?
Oh, significantly better. The review found they typically show performance boosts of 15 to 20% over a pure RL approach. They even cited one case where a hybrid hit a Shark ratio of 1.57, while the pure RL model was stuck at 1.35 on the same task.
And is the industry picking up on this?
Big time. The adoption of these hybrid approaches has just exploded. It went from about 15% in 2020 to 42% in 2025.
I can see why. You get the adaptive learning married to proven financial theory, but I'm guessing the success factors are the same ones we just talked about.
You're exactly right. Even with these advanced hybrids, implementation quality was still number one with an important score of 0.92. Domain expertise was right behind it at 0.85. The choice of the algorithm or framework, still secondary.
Okay, let's talk about knowledge transfer. You said market making was the most successful domain. Is that expertise spilling over into other areas?
It is, yeah. It's acting as a sort of spillover hub. Techniques that were perfected in that really high-pressure, continuous environment are being successfully applied elsewhere. For example, the sophisticated inventory management techniques from market making. They're now being used to improve long-term portfolio strategies.
So it's like taking technology from Formula One and putting it in a normal road car.
That's a great analogy. Another example is bid-ask optimization. That's being pulled from market making and used to make crypto trading execution way more efficient, with gains of up to 18%. That deep knowledge of market microstructure is proving to be universally valuable.
Which leads us straight into the real-world problems. With all this great performance, why aren't these systems everywhere already? What makes finance so much harder than, say, teaching an AI to play a video game?
Yeah, this is the critical question, and the challenges are really fundamental. Number one is still non-stationarity. A strategy that worked perfectly last year might completely fail this year because of a new regulation or a shift in investor behavior. The market is always mutating, and that undermines the stable world an RL agent needs to learn effectively.
And the cost of learning. The cost of exploration is real money.
Exactly. The exploration-exploitation trade-off is brutal in finance. When an agent explores a bad move, it's not losing points in a game, it's losing actual capital. So you can't just have it try random things. That's why developing safe exploration techniques is such an urgent area of research.
And even if you solve that, and your model is safe and profitable, then the regulators come knocking.
Right. The interpretability regulatory conflict is a huge barrier. Rules like MiFID II in Europe demand that trading systems be explainable and auditable. But Deep RL is famously a black box, and that creates major systemic risk concerns for regulators. This is the main reason there's such a big push for interpretable RL.
And I imagine managing risk for a system that's constantly changing its own strategy is a nightmare.
It is. Traditional risk limits that are static just don't work. You need dynamic, adaptive risk management because the agent's policy and its risk profile are always evolving.
And lastly, just proving your model actually works is tricky.
Immensely tricky. You've got data biases, like survivorship bias, where you only see the winners in your historical data. And more fundamentally, some researchers argue the market is a single realization of the stochastic process.
Meaning you only get one history.
Exactly. You can't rewind and test your algorithm on 100 different versions of the 2008 financial crisis. That makes getting true, statistically significant proof really, really hard.
That brings us to the end of our deep dive. So to sum it all up, RL is already delivering real, measurable gains, particularly in those high-frequency, continuous problems you find in market making, and because of the volatility in crypto trading.
But the critical evidence-based takeaway for you is this. Success isn't about chasing the newest, most complex algorithm. It's driven by operational rigor, deep domain knowledge, and high-quality implementation. It's all about that measurable complexity score.
And the future seems to lie not in replacing old methods, but in building these sophisticated hybrid systems that merge the adaptive power of RL with solid established financial theory. It's about convergence.
Absolutely. And that focus on rigorous, compliant application is pushing the research in some really interesting directions.
So as you keep an eye on the future of AI in finance, there are two things to watch. First, with regulators demanding transparency, how quickly can researchers deliver truly reliable interpretable reinforcement learning, or IRL? That feels like a mandatory step for mass adoption.
And second, beyond just making money, where can RL provide real social value? The review actually pointed out that ESG investing environmental, social, and governance is a huge growth area. They're using RL to balance financial returns with sustainability goals. And that suggests a pretty fascinating convergence of this powerful technology and, broader societal aims.